The challenge with traditional real estate is that if the neighbor sells for a low price, that could significantly impact the value of your property. The good news is that multifamily real estate is valued differently by banks and by sophisticated investors. That makes it more predictable with less risk. And today we're going to talk about the 3 ways that real estate is valued and the most preferred way in order to have a very predictable return moving forward. John, it's great to be here with you.
Mark, love to be here. So excited for today's topic. And, you know, it's interesting time, right? The Trump administration is coming in and we're starting to see nominations. And so in a future episode, we'll dive into some predictions around what we expect to see. But just kind of in short, very much developer, owner, operator friendly, incentivizing more development versus disincentivizing with things like rent controls we've touched on in the past. So it's good to start getting some clarity around what to expect over the next few years, and you know, just looking forward to that further discussion down the line with you, where we dig in a little bit deeper.
Well, one thing that Trump made clear is that he really wants to have lower interest rates, and so it was clear that he wanted to put pressure, and he was going to put pressure on getting that lowered. And so we'll see with the treasuries what happens here, but ultimately that could light this real estate industry on fire again. What are your thoughts on that?
Yeah, it's interesting, right? You know, so everybody sort of expected the rate cuts. You know, the Fed made some pretty good rate cuts last year, 3. And as they made those cuts, we actually saw an inverse relationship where the treasuries actually went up. And so some of that is just the you know, I guess in a sense, the fear of the unknown. You know, Trump has talked about some things like tariffs that could in the short term be inflationary. So it seems like that's being priced in. But what we're also starting to see, which is good, is the spreads, you know, that what the bank basically makes, you know, the treasury and the spread is the effective interest rate you get when you get a loan. And so the spreads are starting to compress a little bit. You know, ultimately these banks have to lend money to stay in business. So they're taking a little bit less to kind of keep things flowing. But, you know, in the short term, those high treasuries will put pressure on owners that may be bought with floating rate debt. And troubled operators will probably be in a place where they're kind of forced to sell, which actually, you know, it's not a great position to be in if you're that owner, but for buyers, there will be some good opportunity. So I think it's just, you know, there's always that unknown when a new administration comes in and what are the priorities really going to be and what will actually come through. So, you know, to your point, Trump's made it very clear he wants those rates lower. So it'll be something I suspect we'll see kind of more in 2026. But as buyers, which we are, I think it'll actually open up a lot of opportunity for us.
Yeah, and that's what we're seeing now, right? When we're speaking with these brokers and, you know, they're letting us know what these sellers are saying. And basically we're seeing, okay, you know what, we're not going to see interest rates probably change immediately. So, you know, okay, let's go to market. Like they've been waiting for the election to happen. They're waiting for the new year. And so this is actually very beneficial for us as buyers because we're going in and we're seeing more opportunities now than we've seen in the last 6 months.
Yeah, I mean, really, start of January through, say, mid to end of January, really the 3rd week of January, we've seen about as much deal flow as we saw in the last 4 months of the year. So definitely looking like the tide has turned with options for buyers. And so, you know, it still comes down to, you know, you've got operators that may have to stroke quite a large check or walk away from a large amount of money. And so the deals still are a little tight. You know, you got to really sharpen your pencil. Yeah. And for us, you know, we've touched on this in the past, but, you know, 1 out of 200 deals works for us. So for us, it's all about how do we just get more at bats. And so, you know, the team are pounding the phones, calling every broker and, you know, loving on them as best as we can to get those opportunities.
Hey, John, I think you just might be too picky. 1 in 200.
You know,
1 in 100 is not good enough. We got to go to 1 in 200. But
yeah. Well, you know, at the end of the day, you know, we take what we do very seriously, right, Mark? Yeah. And we put our own money in these deals alongside our investors. So, you know, it's got to be a screamer. You know, I always say if it's not like a strong, like almost like a hell yeah, then it's a no. You know, because
it reminds me of one of my buddies. He's a super like strong influencer, and we were having a beer one night and he said, you know what, Mark, he's like, maybe I should lower my standards. He had an employee that just wasn't, you know, ponying up to what his level was of, we'll say accountability and just overall production. And he said, maybe I should lower my standards. I said, hey, like there's no way you should lower your standards. They're just not the right fit. The high standard is what makes you great. That's what makes you stand out. That's what got you to where you are. Like, whatever you do, keep that high and even level it up even one further. And I think that's where it goes back to, I crack a joke about being too picky, but the reality is that we have to be picky in these deals because, you're buying a 100-unit apartment building and you're spending, tens of millions of dollars. You can't get it wrong on that. And I think pickiness is actually part of what an effective operator is, right?
Yeah.
Saying no to more opportunities, way more than yeses. And that's what Steve Jobs said. He had said, I'm more proud of the things that Apple didn't do than the things that we did.
That's right. Yeah.
Cool.
We both have children and, you see it work, at least I do. And I know you are very close with your kids and treat them the same way. It's like, you put them with some high expectations and that's the results you get. Low expectations, you get those results. And so, I think there's really two challenges in the world right now, probably in history, but, certainly still impacting us. It's a lack of leadership and it's a lack of, or I would say a proliferation of low standards and low expectations. I don't know why, but I was just born with very high expectations about what I expected out of life. It was probably my parents and how they kind of raised me, but I've always had high expectations for myself and for the life I create. Yeah. And, I know you are somebody as well. And, you get those results, right? It's the power of, positive thinking, I suppose, but just that low expectation. So to your friend, it's like, no, you just got the wrong person. It's the wrong, they're the wrong seat of the bus or the wrong person, right? You got to go out in the marketplace and find somebody with your standards. And, at the end of the day, as the leader, you have to meet those standards too, of course, right? And so for us, I don't expect our property managers to do anything that I wouldn't do. So you'll remember that time we were touring one of our assets and this person's no longer with the company largely because of this experience, but we picked up a bag of trash. I mean, like a huge, 5-gallon bag of trash or whatever, or 25, whatever the gallons are, of cigarette butts and just paper and waste. And it's just like, this is unacceptable. And I'm willing to do it. Why did you step over that 17 times on your way into the office? So, it's all about high standards for Faris Capital. And just, I think in general, it's everybody should have higher expectations for themselves.
It's interesting. You had said, you were brought up with high expectations. When I think back on my parents, we grew up on a farm, right, John? And so there's nine kids in our family, and I was the oldest boy. And when I think back about like the standards, it was more about with my parents, they were more lead by example. And so it's interesting when I look back on it, I don't recall any sort of like stump, speeches of, this is our standard. These are, as more like, well, growing up as a Christian, there were values there that we needed to live by, but ultimately, there wasn't like this high standard in regards to conversing with us as kids. It was more lead by example, right? This is how I live, and so I think we saw that. And because my dad was a farmer, he never really just woke up and went to a job. It was more, he kind of woke up and he went out and found business. Eventually we got into excavating. And so, it's interesting how there's different ways to create leadership. There is here's the standard in regards to voicing it and saying it. And then, what also is another way to do it, which you can stack one on top of another, is like, hey, follow me, lead by example, watch me. And you don't even need to say anything. It's just you kind of watch and kind of monkey see, monkey do.
Yeah, I mean, it's not unlike sales, right? Show, don't tell. So you show whether it's your kids or your employees, you show them, how to do the job and how to behave and how to comport themselves. And I think I'll put a bow on this, just thinking this final thought here. But the number one indicator as to whether someone will become a reader as they grow older in life is just simply seeing their parents read a book. Growing up. So if your kids come downstairs and see their parents on a Sunday morning or whatever with a cup of coffee, or Saturday morning reading a book, they may not take up that habit today, but they will in the future. And that's me. My dad and mom always had a stack of books on the bedside table. And so I just, I followed along. Right. So, it's all about leading by example. You nailed it.
You just gave me a good idea there, John. I think I'm going to take my book from reading in my office and reading my bedroom and go walk around the house there and just say, hey guys, how's it going? I'm just reading this book here right now. Just make it a little bit more, we'll say, in their face there. So that makes sense to me.
I've got a 20-year-old, and growing up, in high school, he was an A+ student, literally like, 4.0 GPA plus, right? Because he would take some additional college level courses, but wasn't a big reader. But now, in college, he's picking up books and reading books. And it's cool to see, because I didn't have to make him do it. He chose to do it. So you're right. I think that leading by example is so critical. But diving in, man, this valuation question, it can be a bit of a black box, especially for newer investors, especially when we're talking about these larger assets. And I know sometimes when you and I are talking with investors, you can feel that sense of confusion around it because, so wait, how does that value get created and what does that really look like? And so I'm excited to dive into this topic and really demystify it because, the income approach, right, is it's actually pretty straightforward and simple. Now, there's some mystery around cap rates sometimes, which we'll get into, but, really it's just a quick multiplication factor, right? So once you wrap your mind around this, you really understand the power of the income approach and these styles of investing.
For sure. And I think it's really important to start that just to throw a blanket, there's 3 different ways you can value real estate. And so the first way is when our previous roles in real estate, when we were selling residential real estate, we would go in, John and I would go into a property. I was in Canada and John was in the US, right? So we'd go out on these listing appointments and then we would grab 3 to 4 recent sales, comparable sales. And then what we would do is we'd make adjustments and then we'd say, okay, here's the value of your home based on what these other properties are selling for. So that's the direct comparison approach. Okay, for residential real estate, where you're moving in and there's no sort of income coming in, that is a prevalent way to value these properties. So that's direct comparison approach. So your realtor, that's what they know. The second approach is the cost approach. And so this is where you're looking at, and by the way, these appraisers, they do value in general, they value it these three different ways. Okay, so the direct comparison, the second is the cost approach, is how much does it take to replace this asset when it comes to building it, right? So that's the cost approach. And then the last approach is what investors primarily use to be able to value properties. And it's the income approach. And the income approach is a very predictable way to be able to forecast values. It's a very predictable way to be able to come in and see a property, see where you can add value, where you can add income to it, and it'll spit out a value based on a formula, which we're going to be talking about today. But why we like it so much is because it's predictable and there's less risk in it.
That's right. Yeah, the direct comparison is the one, as you mentioned, most people would be familiar with, and those adjustments, right? Maybe this house has a finished basement and yours doesn't, or there's a quality level to a renovation that occurred. And so it actually, to me, can be more challenging in a lot of ways because, tastes start to become a factor, right? Did they pick the right paint color or the right granite? And so that emotional component kicks in. Where, cost approach, pretty straightforward, right? It's replacement. What would it just cost to build this thing again? But the income approach, once again, to me, is actually a little more scientific, which is what I really like about it. I would say the comparison approach, there's an element of art involved, right? And if you're finding a realtor to list your home, experience is critical, and, somebody who really deeply understands that area because just nuance gets involved, right? Where I would say with the income approach, there's really not a lot of nuance. It's really just about what's the market look like, what are the prevailing cap rates, which we'll get to, and then how much more income do you think you can drive in that investment, and secondary, how can you reduce expenses, which we'll talk on, but that's a little more complicated and challenging these days with inflation and higher insurance costs, et cetera. So I like that because the income approach, because it just feels like it's like science. It's not like a guesswork, right?
You nailed it. And you said that so well. I mean, the direct comparison approach is there's more emotion involved with the value, right? You have a buyer that walks into a home and they just, the wife falls in love with the kitchen, and then they go to the bathroom, and all of a sudden they're like, "Oh my goodness, this is phenomenal." Or they go to the backyard, and it's the backyard that they've always visualized for their kids, right? And the realtor is really strong. There's like huge. When I say realtor's strong on creating the overall vision of what their future life looks like, right? That creates high levels of emotion, and higher emotion when a buyer is attached to it means that likely they're going to be paying a higher price. So emotions are very prevalent in the direct comparison approach, which is like the single family homes. And so it becomes a little bit more challenging to predict what you can actually get and to predict future value. So that's where the other part of this is what John, you had said there. It's a little bit more like sophisticated, logical when it comes to the income approach, because it's just numbers. It's just numbers. And so this is where what John and I found is that the majority of the buildings that we went and walked through, the emotional part of the walkthrough, so the sales center, the model suite, were not, we'll say, emotionally attractive, right? They didn't properly stage it, right? There was no sort of spec sheets there for a new resident coming in, because you have more sophisticated owners in general where they don't have that background on creating emotions when somebody walks in. And so what John and I found, right, John, is that we walk into these and we're actually put that emotional stamp to be able to have them pay more for rents. But the reality is we know that we can generate X amount, but it's for income. And it just gives a competitive advantage if you do pull some of the emotion in. But in general, when you're straight looking at the income approach, it is very much more predictable, which has attracted more, we'll say, logical buyers. And that's where you have investors coming in and where the industry primarily is focused on.
Yeah. And, taking it just a step further, you build all these great relationships. And so in this space, whether it's brokers, lenders that we have relationships with, you can actually talk through things like the cap rates and where they're seeing them going and kind of what the consensus is around these things. So it becomes a little bit easier to predict that future value where, I would say, that is the challenge of kind of understanding and how cap rates work and how supply impacts and how other economic factors impact. But once again, you can kind of go out and say, what are you seeing? What are deals currently trading at? And so, you buy a home today and you try to predict the value in 5 years. It's a lot more challenging with that direct comparison approach. All it takes is a neighbor with a bit of a fire sale. Maybe it's an estate situation. They just dump the property quickly, and now all of a sudden it's pulled your value down. Where in our world, a fire sale, if you will, or a property that has some issues or whatever won't necessarily impact ours because, at the end of the day, it's a formula, right? Which I'd love to hear you kind of walk our investors through that formula. What does that look like?
Yeah. So if you think of a triangle, and it's as simple as this, if you think of a triangle, the very top, so there's a triangle, and then in the middle, there's like a cross. So, or we'll call it a T. Okay. So there's a triangle and the T. And so that very top of the triangle, this is the net operating income, or the income of the property. And so what is net operating income? So net operating income it's almost like EBITDA in a business, right? So you take all of the income that comes into the property, okay? So we'll just say laundry income, trash income, rental income, you take all of that. And then what you do is you subtract your expenses from that number. And so expenses would be your taxes, your maintenance, your insurance, your property management. You take all of that away, and then that gives you your net operating income. Now, your net operating income sits above your mortgage payments or your debt payments, okay? So the way that you establish net operating income, you assume pretty much that you buy the property, you own the property cash. And so there's no mortgage payment. And so that net operating income basically is the number before your mortgage payment. So that's your net operating income. So that's the top of the triangle. And then the bottom left is your cap rate, or they call it a capitalization rate. And so this is just a simple way to measure the return on a investment property. So for example, if you own the property cash, what is the overall return? So let's just say, for example, you own the property, a property that's, say, valued at $1 million, okay, and it's got a 5 cap. That means that the net operating income is $50,000. So that's 5% of the overall value of the building. That's called a 5 cap, okay, or 5 capitalization rate. And so that's on the bottom left. And on the bottom right-hand side of the triangle, you have the market value, okay? So there's 3 different sections within the triangle. So you have your income, your net operating income on the top, you have your cap rate on the bottom left, and then you have your value on the bottom right. And so if you pretty much take your income and you divide it by the cap rate on the bottom left, that's equals the value. If you take the income and you divide it by the value, it spits out the cap rate. And if you take the cap rate on the bottom left and you times it by the value, that spits out your net operating income. So it's a very cool triangle there that the formula works out each and every time, that if you have 2 of the 3 parts of the triangle, you can figure out the third.
Yeah, no, for sure. And, you may ask, why not include the mortgage, right? Well, it goes back to the cap rate is really a focus on that cash return, right? So it's assuming it's a cash, full owned property, right? So I think that's kind of one of those important things to note. So that example of that $1 million deal, 5% cap rate, that means $50,000 in net operating income. So, leverage becomes one of the advantages of these types of deals. And you can see where the value isn't impacted by the debt you take on. Now, that all to say, you have to be mindful of the type of debt you take and, the property, and obviously the NOI is impacted, or not necessarily the NOI, but the total profitability of the deal is impacted. But that cap rate is really talking about that cash return, as if it was owned outright, right? So I think that's just one point to nail down. You mentioned it, but I think just putting a nail into that is really helpful just for future understanding.
Yeah. And so one of the other reasons to just stack on what you had said, John, is that there's many different types of debt. And so the reason why you don't include it, another reason why you don't include it, is that you can compare apples to apples when you're assessing deals, right? So if somebody maybe they assumed a low interest rate and they're going in, they're assessing how much cash flow they're making. The reality is that that's going to be completely different if you get, say, new debt and you got to take out 6%. The deal could be, the exact same, but the results, or we'll just say the overall, the returns will be drastically different. So to give it each property a level playing field, that's why you just don't factor in the debt when you're assessing these properties with net operating income.
That's right. And, cap rates can be impacted by a variety of factors, of course. And so it's not as if you go into a market and everybody agrees that, well, in this market, everything trades at this, cap rate, right? Vintage could come into play, the class of the particular building or the area. So, a C area with a C asset is going to trade at a higher cap rate. Now, that may look good because it means better returns potentially. And I think the operative word there is potentially, because typically higher cap rate deals come with higher risk. And that's a great example. C asset in a C area. Yeah, if everything goes perfectly, you might have this better return, but the reason you're getting it at that price, right? Because a higher cap rate means a lower, value, is that additional risk is baked in. And so, one of our challenges sometimes is cap rates aren't always widely available in terms of, I can't go always look at a sale and find out exactly what that cap rate is. You often can through calling the broker and, digging in a little bit. Some brokers and some operators do let folks know and kind of put it out in CoStar and some of the other platforms what their cap rate was on that particular transaction, but it's not always available. So it's really critical that you really know the market. And it's why we focus on a handful of key markets and not try to buy assets all over the United States, right? Because, you really have to understand what's happening in that area from the economic drivers, the demand drivers, population growth, and all that. And you really have to have a clear understanding of that. Now, we do have the benefit of some forward-looking projections that are provided by different data sources like CoStar, RealPage, and other data providers out there. But these are just guesses. So, what's your philosophy on sort of exit cap rates? And I'd say today we're here in 2025. As we mentioned at the top, Treasury is a little bit higher. So, Mark, how are you thinking about cap rates in terms of an exit in the future?
Yeah, like for us, it's the It really is based on, we're looking at the different areas and where it's at. I mean, that's the first thing that we look at. But down the road, we want to be really conservative in regards to what those future cap rates are, because even a half point, this could be millions of dollars of what the exit and the overall returns are. So we're really conservative. There's a platform that we spend tens of thousands of dollars to be a part of, CoStar. They give really strong predictions of what they see in the future based on the number of properties coming into an area, based on the demographics and the population growth and jobs, and they factor all that in. They have hundreds of analysts, and they make predictions. So that's like one of the data points that we look at as well. I know we look at Treasury future predictions as well, and the reality is that you got to be very conservative with that. So whatever the going in cap rate is, if you're going, we'll just say if you're coming in lower than that, you got to really believe in the business plan. And so, John, the one thing that trips up a lot of investors is that with these cap rates, that it's a funny thing. The higher the cap rate, the lower the value is, right? And the lower the cap rate, the higher the value is. So if you bring it down and you factor that into that formula we shared, I think that's what trips a lot of investors up with that. It's like there's a play there on how you see it. Well, higher cap rate, that means that it'd be a higher value. Well, not. It actually means it's a lower value. And so the reality is that is something when you're factoring in values and you're looking at these, you got to really be careful not to get caught up to go the opposite way. And so that's more of once you get into the business there, you start to see that and becomes like second nature. But the reality is that, the way that these work with these cap rates, the values that it spits off are something that you got to be really mindful of.
No, for sure. In our world, we're typically underwriting at the going in cap rate at exit, or maybe even a little bit higher. Now, what's interesting is if you were to, ask me to place a bet on it, in the markets we're currently buying in, I would suggest cap rates will probably be lower in 5 years. But you don't want to just go, well, it looks that way, right? And so, there's great examples where CoStar may say, hey, you're today it's 5.5. We think in 5 years it's going to be 5. We would probably still underwrite that deal at 5.5 exit. It's just a way to be conservative, and then hopefully we're pleasantly surprised. But it's interesting when you look at multifamily. Multifamily actually historically kind of trades at around a 5% cap rate, and so another way you can leverage cap rates is actually determining whether we might be in an overheated market. And so if you look at 21 and 22 as a great example, sort of the dust cleared on the pandemic in a lot of the states in the US, particularly in the Southeast. And by that, I mean, most of the United States, I think it was like the pause for 45. They had some catchy phrase around it. And so there was a little bit of that, but pretty quickly the red states started opening up their doors for business. Now, a local municipality might have had some rules, but unlike Canada and maybe say New York and California, we were pretty open for business. And so things started exploding and values got out of control. And what was happening is buyers were buying at like 4% cap rates. And so it's something we've talked a lot about here at Faris Capital Partners, is that let's be mindful of that. So maybe in 5 years, if we see a market like that, that's actually a signal to maybe pause and pump the brakes a little bit, maybe exit some deals versus acquiring, because the good times don't last forever. And that's where a lot of operators got in trouble. They overbought in an overheated market with those really low cap rates. And so not only are they dinged on their interest that they had floating rate, but the exit cap, the rates have expanded, right? The cap rates have expanded
significantly.
So once again, typically you're seeing, and this is like kind of an average across the entire United States. So every market's unique and different. So we got to keep that in mind. But that 5-ish% is usually where a quality, say B to A multifamily asset is trading.
Well, we even saw some properties trade at like 3.5 caps in some of these primary, larger markets. But the interesting thing here, another factor you got to really look at when you look at properties and you look at cap rates of what a property is actually and how it's performing. One of the biggest things that I look at coming in is primarily it's not even the cap rate, because it could be completely skewed based on how underperforming a property is. So one of the biggest numbers that I like looking at first and foremost is what is the monthly lift opportunity. So John gets this all the time, right? And so same with our acquisition specialist, Joe, we come and there's a deal that's presented. And my first question always is, how much left in this property? What's the upside that we can drive rent? So for example, if a property is, maybe it's under market value for, maybe $100, maybe the existing owner is not doing a good job at operating and they just haven't been aggressive with raising their rents. There's $100 there. They're all classic units and we know we can get $150 there. So that's $250 per month extra. And it's like, okay, they're not charging for laundry. We got another, say $25, say. We got valet trash. It's like, so all of a sudden when John and Joe and they're presenting an offer and we're looking at it together, it's like, this property has over $300 lift on that, but it's running at like, say a 4.5, 4.75 cap. The reality is bringing in less income, but the upside is there when we go and do the renovation. And so I would just suggest, when you're looking at assessing properties based on the income approach, cap rates are an important factor when you're valuing properties, but there's a deeper story there that needs to be told, and you got to really dig into what's the potential upside. John, we had the deal where the owner was paying their daughter, it was like $250,000 to manage the property, which was like, we'll say like 4x higher than what it should have been.
Yeah.
And the reality is that if you can take that off the books for your expenses, all of a sudden your net operating income drives. So there's more levers than just the cap rate when you're factoring in. There's like examples of what is the overall potential lift in the property as well.
Well, I know there's two things that get both you and I kind of like fired up, right? It's bad reviews when we like the asset because it's a management thing. We know
we love that. We love
bad reviews. We're going to come in and straighten that out real quick. But number two, it's that loss to lease, which we touched on previous podcasts. But for the listener that's maybe newer to this, loss to lease is simply what is the in-place rent today and what is the market rent and what is the difference there? So I think our Largo investment was such a great example of that, where the average in-place rents were about $13.50 a door, but the average, market, rate would be $16.50. So walking in the door, we could effectively, now the reality is we're not going to go to somebody who's been there for 5 years and go, your rent's going up $300, on your renewal, because they would leave. And so you have to manage that a little bit, but it's that loss to lease that is like the thing that just gets you really fired up, because without doing a whole lot, just managing better, creating a better living experience, we can start getting those numbers pushed up. And, for us, every investment we've done, in fact, we just closed on one and, a few weeks ago. And from the time we went under contract to today, the market rates have increased by about $50. So we're already $50 ahead of our pro forma projection. So, those are the two kind of key items that when, Mark and I see, it's like, let's get on a plane fast, because that's a deal for us potentially, right?
Yeah, no, we love that. I mean, and that's a huge part with the multifamily. I think, to me, as we get our monthly reports, when we send them out to our investors, we include what the overall rent lifts were per unit. And so based on the net operating income, you just do the math in your head, you get X amount bump in income. All of a sudden that spits out huge amount of value. So in some cases, it's like some units when we're turning, we're getting over $100,000 in additional value just by one rent bump on one unit. And so this is where you start doing that to 100, 200 units. This is where it's just like, that's kind of like Christmas for me, John. When I see that monthly and all of a sudden George is like, hey, we got $200 over a pro forma, and we went from $1,400 a month and we were able to sign something at $1,900. We just had that this week. It's right. Like we're overshooting our projected pro forma. All of a sudden, for every $100, all of a sudden, like you're increasing it by $24,000 in rent bump. So that becomes massive. $500, you're $125,000 in value increase. And so this is the kind of potential that this has. Yeah. So John, that's actually Google reviews. And the other one is when we get these big rent bumps like that, it's really exciting.
Well, and it's like worth repeating, right? $500 more in rent on a monthly basis, $125,000 in value created. Now times that by 100, right? And now you see where the magic really happens here. And so it's not easy. I mean, you have to operate with excellence and we micromanage these deals. It's, there's no other way to say it. I'd like to say we just manage them aggressively, but we're in the weeds. And, Georgia, she's like the velvet hammer or something. She's, super smart, super sweet, the nicest person, but man, she does not take any crap off of anybody. And she expects high results going back to expectations. And so we micromanage these deals to ensure that these things occur. And by being conservative on the front end, when you get those wins, that's amazing for the investors, but it also builds in a little bit of, what if something else happens, right? Like what if there is a temporary setback, in a marketplace and now we're ahead. So you can kind of absorb those things that may come up, those black swan events, if you will. And I think the other factor here too is, you sometimes apply multiple approaches when you're valuing a deal, not unlike an appraiser. So one trend you're seeing today, particularly with newer assets, which we don't typically target, but like there's buildings that, maybe started permitting in 2019, 2020. And, when you're taking down a construction loan, you're paying much more in terms of interest. And these are bridge loans, they're short term. And so a lot of operators, or really I should say developers, started building buildings and then their rates increased dramatically. And so there's deals that are trading today at below replacement cost. So that's that cost approach. So it's kind of a metric you also want to look at, because at the end of the day, our building might have been built in the early 2000s, but if we're buying it at like 60, 70% of the replacement cost, that's also going to push values up, because new developers have to build and they are constrained by materials costs and regulatory costs and land costs and all those things. And so, they're not running charities. They're going to have to get a certain rent for that investment to work. So it actually pulls up the values behind it. In fact, Blackstone, one of the world's largest private equity firms, got into the single family rental game in a big way during the Great Recession. And at Marksman Real Estate, we actually served them. They were one of our clients and we sold them thousands of homes. But the key metric they looked at is, so in their world, they were doing the comparison approach, the direct comparison approach, and then that cost approach, because they knew if they bought a single family home at 70% or less of replacement cost, that once new development started in, say 2012, 2013, which is about when it really ramped up again, they'd be in the money. And it was, probably one of the better investments, if you could have gotten involved in it, that you could have made at that time. So we're looking at that as well. We're not targeting those newer deals, but, when you see that 80s, 90s, or 2000s building, it is actually still a factor that you can look at just more from a future, value perspective, because that will pull your value up if you're buying at a significant discount to replacement cost.
That's a great point. And, we don't, with inflation, how it is with the money printing and everything, it's a hedge against inflation. And so buying under building costs it's a real smart move. And it's again, another hedge for potential downside there. So I hope this was valuable, guys. Just a recap here on what we talked about. There are three ways to value real estate. There's direct comparison, you got the cost approach, and then you have our preferred income approach, right? Where it's the most predictable and the least amount of risk when you are buying properties. The second point is that it is predictable and there's lower risk, right? And so this is what savvy investors use, and banks, by the way, to value properties. This isn't just something that John and we're just, randomly pulling out. It's like banks look at this, which, if banks are doing it, then likely it's a pretty conservative way to value these properties, right? And then the last point is that based on the income approach, the more income you can add to a property and the lower expenses that you can make happen, the higher net operating income is on the property, and ultimately the higher value you'll be able to sell it for, and the higher the returns are. So with John and I, when we wake up every day, it's like hardcore. We're thinking, how can we increase the net operating income on our buildings, okay? And a big part of that is like culture and operational excellence, and that's what this show is all about. The Multifamily Investor Playbook is just sharing how we're going about executing on these properties. And you guys can take this and, apply it to your own real estate investing career. But also you can say, you know what, the reality is that seems like a lot of work. I'm really busy killing it in my business over here. It's like, okay, I know from an investment standpoint that you guys how you're operating is exactly how I'd want to do it as well. And so that might be an option for you. But regardless, the mission is to be that ultimate resource there for high net worth multifamily investors to be able to get ahead and get higher returns moving forward. Anything else, John, just to wrap up?
No, I think it's once again, just the most straight down the line, just easy, once you wrap your mind around it, best way and easiest way to value a property. And it's why we love multifamily investing.
Mm-hmm. Right on. Well, thanks for listening, guys. If you enjoyed the show, please subscribe and share it with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming big.